Hi, Andy Norrington, Independent Financial Advisor at Sterling & Law based in Croydon. Welcome to part 2 of the Retirement Income Options series. Last week we looked at lifetime annuities, and today I will be discussing the main alternative, which is Flexi Access Drawdown. I'd like to start by thanking those who have commented below, and for those who have contacted me directly, I'm really pleased you're finding the content useful. As before, this is not financial advice. This is designed to be a high-level overview to help you make an informed decision. So, what is Flexi Access Drawdown? Well, there's a clue in the name. It allows you to flexibly draw an income directly from your pension fund, allowing you to take as much income as you like, whenever you like. Of course, this comes with risk. To give a simple analogy, you might imagine in the office you've got one of those large water tankers whereby you can help yourself to a cup of water at the bottom. The water at the top represents your pension savings. Whilst it remains in there, it is invested and it's growing tax-free because it's in a pension tax wrapper. The income at the bottom, which is your water, you can take as much as you like whenever you like, but of course over time there is a danger that the water at the top could eventually run out. So there are two key risks here. The first is longevity risk. We don't know how long we're going to live, so this has got to last us an entire lifetime. If we live to 110, that might represent some problems. The next is investment risk. Now, whilst over a long-term period, you can be confident your investment will go up, in the short term, investments are volatile. There's going to be good years and bad years. It's during those bad years when you're also selling down the investments to fund your income, when it's going to have a detrimental effect to the overall pension pot, and that could affect the long-term sustainability. Next is the tax-free cash. You might remember with the lifetime annuity, your only option is to take it as a one-off lump sum at the outset. Under Flexi Access Drawdown, you can keep it invested, and if you prefer, you can take it out in small amounts over a number of years, again flexibly, however it suits you. One of the biggest mistakes people make with tax-free cash is they reach age 55 and they decide to take out their 25% tax-free cash just because they can. By doing this, you're taking money which is invested and growing tax-free and putting it into a current account where it's getting 0.1% interest. If you don't need the tax-free cash, leave it in the pension until a time in future when you do need it. That is a big mistake people regularly make. Next is the flexibility. Now this is great for two reasons. Firstly is you can tailor the income to suit your lifestyle. It's quite common, people when they retire spend a bit more in the early years whilst they're active and healthy, and that tends to tail off towards the 80s. It's also useful because you can manipulate the income in such a way to minimise your tax bill. So to give you an example, let's say you've worked out that you need an income of £18,000 per year, which is £1,500 per month. Most individuals are entitled to a £12,500 personal allowance. This means your first £12,500 of taxable earnings fall within the nil rate band. Earnings above £12,500 are taxed at 20% basic rate. So in order to achieve your £18,000 income, what you might wish to do is take £12,500 of taxable income, which uses up your nil rate band, and then with the shortfall, the remaining £5,500, you can actually take that out directly from your tax-free cash part. That way you're achieving your £18,000 income target and you're not paying a penny of tax. So it's very clever how you can manipulate it in that way. Now with pensions, the priority of course is to make sure you're getting an income in retirement. But with Drawdown, it's actually a very good tool for intergenerational wealth planning because money within your pension when you die actually sits outside of your estate for inheritance tax purposes. If you die before age 75, the remaining pension can be passed on to the beneficiary completely tax-free. If you die after 75, it will be passed on tax-free. However, when the beneficiary comes to withdraw the income, they will be taxed at their marginal rate. So overall, Flexi Access Drawdown is a lot more complicated than an annuity, as I'm sure you can see. So to summarise, the positives of the drawdown option are that it's completely flexible, which allows you to tailor the income to suit your lifestyle and also to be tax efficient. It's got more choice around the death benefits, and the negatives are that it is complicated. It is suggested and recommended that you do take ongoing financial advice. There are fees involved because you've got to pay for the underlying investment, the pension provider, and possibly a financial advisor too. Hopefully that's been a worthwhile listen to. I'm sure there's going to be some questions off the back of this one, so I'd love to hear from you. My contact details are below, and thank you again for listening.